Stocks are opening lower on Wall Street Thursday, but are still holding on to sizable gains for the week. Traders are turning cautious as oil prices surge again, pushing U.S. benchmark crude up 7% and back above $100 a barrel. Now that's a worrisome sign for inflation, which was already a major concern for markets even before Russia's invasion of Ukraine 3 weeks ago. The S&P 500 lost 0.2% in the early going. Treasury yields eased back a day after rising sharply as the Federal Reserve raised its benchmark interest rate for the first time since 2018. Well, this was to help tame the worst inflation since the early 1980s. Well, joining us now to give us deeper insight into this move is Brendan Caldwell, Director of Caldwell Securities Limited. Brendan, welcome back to Forum Daily.
Thank you, and happy St. Patrick's Day, Nima.
Happy St. Patrick's Day, Brendan. Now, the Federal Reserve took their first step to contain inflation yesterday. So what does this mean for investors in the near term?
Well, let me just qualify what you said. The Federal Reserve took their first step to be seen to try and tame inflation. Whether what they're doing tames inflation or not remains very much to be seen. But with inflation up in the mid to high single digits, the U.S. Federal Reserve, the central bank of the U.S., wants to be seen to be doing something. And historically, if one raised rates, that tended to slow down inflation because it made it harder to borrow. And if an overheated economy was the cause for inflation, then higher interest rates could potentially, at least theoretically, be the cure. In this particular case, it's not really an overheated economy that's driving it, but more a shortage of goods and services at the prices we're used to because of a whole bunch of different global factors, which we can go into. Your question was, what does it mean for investors? Well, the market took it very well yesterday. It was up several hundred points. As you said at the introduction, it was the market opened earlier today lower, but sort of as the days rolled on, the markets got a little bit stronger. So held on and then some to all the gains from yesterday. So the market's reacting very well to this, and we can look at why.
And what about those who don't invest, Brendan? What does this mean for just regular consumers?
Well, the tricky bit for anybody that's got a mortgage mortgage, let's start with that. Not everything is keyed off the U.S. Federal Reserve rate, or the equivalent in Canada is the Bank of Canada rate, but floating rate mortgages are really keyed off the prime rate, which is then keyed off the Bank of Canada rate. And as that begins to tick up, and the Bank of Canada raised its rate in the last few weeks as well, as you begin to see those rates go higher, those with floating rate mortgages are going to end up paying more interest and a higher monthly payment, or at least less in the way of repayment of the principal over the next little bit. So where it's going to be felt, I think, most keenly for most people is in home ownership. But then I think those on the margins that pay from the price of bread and basic foodstuffs is a big deal. Seeing higher inflation, indeed higher interest rates, may also be a big deal as well.
All right, Brendan. Well, taking a look at the markets in particular, are there any particular sectors that might respond worse to this rate hike?
Well, historically, those stocks that are trading at big multiples to their earnings. So if you're a high growth stock, like an Amazon, say, or any of the FANG stocks where your future earnings are being discounted based on a projected level of growth, that discount rate is based on current interest rates. So if interest rates begin to go higher, the discount of future earnings tends to be greater. So those historically are the stocks that have got hit the hardest. And we've really seen that since the turn of the year, as the fear of interest rates going up has hit those really high earnings multiple stocks quite hard. Yesterday and the last few days, actually, they've been responding quite well. So now that interest rates are actually going up, the stocks seem to be going up as well. So it's a little bit opposite to what most people might think.
All right, Brendan, just a quick 45 seconds left here, but is there anything that we might need to concentrate on just going forward in terms of inflation?
Well, there's so many things, but I'll answer the investment question, which is if you're looking at stocks to buy, it would be more important to be buying stocks with increasing dividends, with a history of continually growing their dividends, rather than ones like a preferred share or dividends that have been static. Or you're much better off, I think, as investors looking at companies that have the capacity to continue to raise their dividends, because even as inflation and interest rates are going up, earnings and dividends from those companies can and should go up even faster.
All right, Brendan, always a helpful conversation. Thank you again for your time today.
Thank you, Nima.